Well, we get now to the macro section of the show, Macro Matters. We talk about economies, global markets, and so on. And we're joining Stephen Schultz, who is with Momentum Investments. Hi, Stephen. Looking at the big picture, we've moved from our stocks and shares on the South African scene. What is the big picture at the moment?
Yeah, so perhaps it's, on a Friday evening, it's a bit more deserving to have something a bit more upbeat. But in contrast, and I suppose in contrast to the video that we just saw, macro matters are slightly less positive, and in particular the dislocation that we're witnessing at the moment, and that dislocation is asset prices and global growth.
Yep.
So Stephen's taken us to a point where there's a graphic representation of exactly what he is talking about. So if you can pull that up on the screen for you and get Stephen to talk us through what the snapshot actually shows us about the state rather of global equity markets. It's up on screen now. So Stephen, talk us through very quickly, what are we seeing here?
Yeah, so effectively we've got two lines over there. The line on the top is global asset prices, and in particular equities via the MSCI World. The bottom line is global growth. And what you can immediately see in the first half of the graph is a pretty healthy trend of positive correlation.
Sorry, before you go further, Stephen, what's the axis at the bottom? What's the timeline there?
The timeline's from the early 2000s until
so it's about
today.
a decade?
Correct, yeah. Correct. And we see the years preceding, you can immediately see in the middle of the graph the 2008 global financial crisis. You can see the early years there, both of them tracking pretty healthy. So the world economy growing, and by extension, company earnings increasing and equity markets rallying. 2008, we see global equity markets halve and pretty much global growth decimated, and the subsequent recovery. And then we see that shaded portion on the second half of the graph, which is really what I would argue should concern investors, and that is equity markets once again at all-time highs.
All right, before we bring in our distinguished panelists, why this dislocation? We know a lot about it in South Africa, where we've got the top 10 companies on the exchange, or top 3 or 4 companies accounting for half the exchange market cap. Our exchange dislocated from the South African economy. Is this happening worldwide?
I think worldwide, look, obviously a lot of it is shared by many regions, but for the most part, I think it's a monetary policy phenomenon that we're witnessing play out. A lot of liquidity sloshing around the global financial system, and that's causing a lot of asset prices, if not all asset prices, to uniformly record new highs. Bond markets is pretty similar. What is becoming concerning is the fact that we're not really seeing a pickup in global growth.
Right.
And that breakdown in correlation, I would argue, is potentially the fasten your seatbelt scenario.
And Gary, I'm seeing you nodding your head as Stephen is speaking, especially when he gets to the part about global monetary policy, and we know the pending build-up towards that interest rate hike in the US. Tell us what the scenario and what that graph's likely to look like once that kicks in. And then give Stephen a couple of notes for the next round when he comes back.
That's exactly what I was going to ask him. I was going to say, yeah, normally you look at an equity market versus real growth, and you expect almost a leading lagging relationship. That you see the markets take off and then growth slowly picks up later. We haven't seen that yet. Agreed, I think monetary policy is forcing a lot of money into the equity markets. But at what stage is there going to be a wealth effect where everyone suddenly looks at their portfolios and goes, we're actually doing quite well. Consumption does pick up and you actually see an uptick in growth. Do you think that is the next step in that graph, or do you think the next step really is asset bubbles start to pop and global growth is once again decimated?
Yeah, look, that is the concern. So the truth is we're not quite sure. I think really there's 2 factors that need to be considered. So the first one is why wealth effect isn't coming through. So why we're not seeing wage growth, why we're not seeing every country uniformly improving in terms of shape. We've seen the US as probably a standout in a developed market context. We've seen the US in a particularly healthy situation in contrast to other developed regions.
And would you say that that's because the US maybe put in these ultra-loose experimental monetary policies first, and then we're going to see that lag catch up later in the EU that's only now putting in such ultra-loose policy? Correct.
So we haven't seen phenomenal growth come through from the US yet, but I would argue that equity market rallies would potentially continue now in the likes of Japan and
I'm hoping you're going to be controversial, Clive, and you're going to come in and you're going to break this romance that's happening here.
I can see that.
What happened with Clive? I think Clive Clive was conserving energy there. He dozed off for a bit.
Yeah, because the analogy or the picture that's been painted around global markets has actually been one that is phenomenal. If you think about what China is doing in respect to this, it is completely different from everybody else. The Shanghai Composite over the last 12 months has grown by 150%. But you can still see the growth of the economy if you look at the economy at large.
Absolutely.
But the correction, therefore, comes in because we know they come back from double-digit growth. Now they're starting to go right. Now they're talking about around 7%. They're not even saying 7% anymore. So you start asking yourself, is China doing something completely different from the world? Or is everybody else trying to do exactly the opposite of what China is trying to do? That's really what I want to know.
Yeah. Look, I'm glad you speak of China, because that's a rather exceptional case in itself. So if you have a look at the Shenzhen Composite Index, you're talking of a PE of about 67 times, believe it or not. So, I mean, if we look at South Africa, and many regard South Africa as an expensive market, on a PE of about 19, effectively that makes China 3 times more expensive. So clearly a bubble in terms of that particular equity market. And China, I suppose we are seeing it slow, but that's encouraging. A few years ago we were wishing for a soft landing, and that appears to be the case. I mean, previously we recall those double-digit growth numbers coming out of the real estate sector.
So towards the beginning of the week, we were talking quite a bit about the emerging market sell-off that we saw, and we're trying to make sense of it, and of course also adding China to that cocktail and saying, you know, how does China differ from what we're seeing? Stephen, give us, you know, the key takeaway from what we saw develop this week.
Yeah, so I think the big difference between America and China at the moment is America good news is deemed good news, and China good news is deemed bad news. I say that with respect to monetary policy responses. So as soon as we see bad news come out of China, we get a lot of people speculating, getting excited on the assumption that the policymakers are going to intervene to stimulate the economy, which has largely been fueling the rally to date. Unlike the US, when we see good news come out of the US, job numbers last week, we get a lot of people very nervous about an early interest rate rise. So very different themes playing out in both regions.
Yeah. What about Greece? We were told last week that, you know, the websites and the newspapers say, this is the deadline. This is D-Day. And D-Day, of course, was last Saturday, 6th of June. This is D-Day. And then somehow they find a way to package the debt and move it on.
Those Greeks.
This week, IMF and Greeks go back to their respective homelands from Brussels. Talks have broken down. What are the markets doing with this? And how is the world thinking about this? Because it's almost like you're saying, look, when a crisis happens every week, it's not a crisis anymore. It's just part of life.
Look, I know a lot of people are getting complacent about it, but that doesn't necessarily mean one should be underplaying the scenario. So we have seen, you know, the Greeks' payment being extended to the end of the month, but the reality remains, you know, it's almost too late to gamble. If they do, perhaps, I don't want to suggest they are going to, but if they were to default on the payment, many believe they will tumble out of the Eurozone. And I suppose the biggest risk in that scenario would be a run on banks, which we've seen in financial crisis.
Which banks? Greek banks or all banks?
Greek banks is probably the first to go.
And then you've got the domino effect that just could happen. Clive?
Very scary. I love that guy, Tsipras. I love him. He's brilliant. He's like Gary. He doesn't wear ties anymore. He says he can't afford it, and he wears jeans to meetings. And that's why Christine Lagarde actually walked out of a meeting yesterday, didn't she? She was upset. The IMF was upset because Donald Tusk said, you've got now an ultimatum. You have to come up with a plan within 24 hours. You have to put your act together. If you don't do it within that particular period of time, we're going to seriously leave these negotiations. And I think that they're not taking themselves seriously.
I couldn't agree more. I think there's a lot of ridiculous politics playing out, and that's getting in the way of economics. So if you have a look at it from a pure economic perspective, I think Greek citizens and voters are speaking for themselves. I think a lot of support's now being lost, and we're seeing a massive withdrawal from the banking system. So we've seen over 30 billion euros being withdrawn since December.
David, I think you opened a can of worms with Greece.